When we talk with our clients and people out in the community, by far and away, the biggest question we're hearing right now is what can we do if our taxes go up?
Exactly. The government's been using Uncle Sam's credit card, spending like a drunken sailor, and plans to keep doing so. That bill has to be paid for somehow.
So far, we have seen a few proposals for tax increases, and honestly, we expect more forthcoming. For now, the focus has been on increasing corporate tax rates, a higher top end rate for personal income and capital gains, and then the elimination of the step up in basis for larger estates. In other words, the current proposals are only directed at high earning and high net worth individuals and corporations. But thinking back to some of Biden's campaign promises, I certainly think that can expand. So Brian, the big question is, with the potential for these higher tax rates just around the corner, what sort of things should people be thinking about right now?
Well, first off, everyone should be paying attention to legislation throughout the year so you can try to plan ahead. Right now, it's just initial proposals, and we should know that what is proposed and what is passable are not necessarily the same thing. But paying attention to these upcoming negotiations and any expansion of the proposed hike should give you an idea of what's coming before it actually gets passed. Second, if it looks like you are in a group that will experience significant impacts, this may be an excellent time to accelerate income into this year. You might do that by executing a Roth conversion or purposefully realizing capital gains now to increase your overall basis going forward, or maybe another option that's specific to you. But paying taxes this year while the rates are lower versus paying them in the future when they're higher can make a lot of sense.
Now, something that's not in the current proposals, but definitely was an item that's been talked about and rumored, suggests that retirement plan contributions may be treated differently in the future. This could potentially eliminate that ability to deduct some or all of your retirement contributions, depending upon your income levels. Now, if that looks like it's coming, high earners may really want to push maxing out those deductible contributions now and consider Roth style planning for the future. Finally, under President Trump, the estate and gift tax exemptions went up significantly, but those limits may drop under a new tax plan. This is something to watch out for. If those limits drop, it could open a whole new group of people who need to start working with their attorney, their CPAs, their advisors, and consider ways to limit these future estate taxes.
Yeah, so the bottom line is tax laws are in a state of flux. We don't know exactly how the rules will change or what they'll look like once Congress gets done haggling, but we can take some proactive steps now by paying attention to what's going on, thinking through potential impacts, and ultimately taking actions if they are warranted.
Now, for better or worse, we're going to be following all of this very closely. If you have questions about what we've discussed in this video, or you'd like to speak with us about what's going on, please shoot us a message and we will respond to you personally.